Okay, let's dive in. We've got quite a stack of material today, covering some really intense market swings, the digital side,
Yeah, serious volatility.
but also these huge long-term commitments from traditional finance, and then some big regulatory shifts hitting the banks. It's quite the mix.
It really is. And what's fascinating, I think, is the contrast, right? You've got these things designed for stability, the stable coins that just, well, spectacularly failed to be stable.
Right.
And right alongside that, you see these massive banks plugging trillions,
Yeah.
literally, towards long-term, societal stability,
Yeah.
infrastructure, housing, that kind of thing.
Exactly. That tension is sort of the core here, isn't it? The digital promise versus the traditional slow build. So for this deep dive, we really want to pull apart these threads.
Right?
We'll look at first what exactly happened with that stablecoin shock, the crazy price spikes. Then how are these big banks actually putting a number on social value?
Yeah, the quantification is key.
And finally, these new regulations, how are they changing the cost of doing business basically for the banks?
Right. So where do we start? The breakdown seems logical.
Yeah, let's start with the instability, the stable coins. Okay, so the sources, they trace the immediate trigger for all of this recent market chaos back to one specific bit of news.
Geopolitics, wasn't it?
Yeah. The U.S. president hinting at maybe 100% tariffs on China's rare earth exports, and boom, instant fear in the markets.
And it was a serious drop. We're talking, what, $400 billion wiped off the total crypto market cap?
$400 billion. And the forced selling, the derivatives, liquidation.
It was huge, $19 billion. Just think about that, $19 billion in leveraged bets being automatically closed out. That just fuels the fire, forces more selling.
So that headline kicks off this global panic. Investors dump risky stuff,
And they run for safety, or what they think is safety.
which in the crypto world is supposed to be stable coins, pegged to the dollar, right, 1-to-1.
Supposed to be. But this time, that flight to safety just completely broke the system in certain places.
You mean the Bitham incident?
Exactly, the
Yeah.
Bitham anomaly. You had this massive rush for stable coins. But Bitham, the second biggest exchange here domestically, just didn't have the liquidity.
And that caused, the number is just wild. 5,700 KRW for one US dollar tether.
5,700 KRW per USDT. It's almost nonsensical. Pure chaos.
How does US-China news lead to a KRW price spike like that on a local exchange?
Well, the global panic meant investors here were selling whatever they had, KRW assets included, desperate to get into dollar-pegged coins. And the local supply just couldn't handle that sudden demand surge. The pipes got completely clogged.
That's just a fundamental failure of something unstable. The name itself.
Precisely. And understandably, investors were furious. The FSS, the financial regulator, is now officially reviewing it. Bitham blames supply shortages, but
This shows the system is fragile, right? Especially these flash events. Regulation feels like it's playing catch-up.
it does. And look, this wasn't just a Bitham problem. Globally, things got shaky too. USDE, the third largest dollar coin.
It depegged as well.
Briefly, yeah. Dropped to like $70.65 on Binance. The issuer blamed Binance. Some internal error. But the point remains. Even a temporary depegging, as one analyst said, it can really rock the market.
Okay, so the stability promise isn't quite there yet. What does this mean going forward, especially with, talk of domestic KRW stablecoins coming soon? Could this happen again?
Well, that's the big concern. And the solution everyone's pointing to is, well, it's kind of borrowing from traditional finance,
Which is?
bringing in professional market makers, LPs, liquidity providers. Think firms like Wintermute.
Okay.
Their job is to constantly quote prices, buy and sell, provide that buffer, that liquidity cushion. So when you get these sudden demand shocks, they absorb it, preventing those insane high premiums from forming.
Like the system Coinbase uses, basically.
Yeah.
More institutional structure.
Exactly. It needs that formal institutional layer to actually deliver on the promise of stability. You can't just wish it into existence.
So, lesson 1. Digital stability seems to need some old-school financial plumbing. Okay, that actually leads us really nicely into the next part. If the digital side is struggling with stability, let's look at the traditional players. They think in decades, not minutes.
Right. A completely different timescale.
We're shifting gears to KB Financial Group. They put out their social value report, and the headline number is huge.
It is. 6.6545 trillion KRW. That's what they claim they created in social value last year. Up almost 19% too.
Okay, 6.6 trillion won. That's a lot. It sounds almost abstract. How do they even calculate that? How do you put a number on social value?
That's the critical question, isn't it? And it's not just about like charitable donations, they try to quantify the impact.
Oh.
So, for example, they estimate the cost saved by reducing carbon emissions through projects they fund.
Uh-huh.
That saving is counted as social value. Or with loans, if they offer a below-market rate.
Like for specific social groups or projects?
Exactly. They calculate the interest savings for the borrower compared to the market rate. And that difference, that's booked as social value created, making finance more accessible.
Okay, that makes it a bit more concrete. And where does this value show up in the real world?
Well, a big chunk is in what they call productive finance and social infrastructure. The sources highlight over 3 trillion KRW cumulatively that KB has put into things like railways and subways, funding, asset management.
3 trillion for trains and subways.
Yeah. And if you think about it, that connects directly to stability, right? People need to get to work, businesses need transport. It's foundational.
It's stability you can actually see and use every day.
Exactly. It shows they see societal stability not just as a nice to have,
Yeah.
but as essential for their own long-term sustainable growth.
And they're also tackling specific problems like housing, especially for young people.
Yes, that's a really interesting example.
Yeah.
They've specifically targeted investments in youth housing near transit hubs. Places like Yongsan, Konkuk University Station are mentioned. They've put over 680 billion KRW into that, providing apartments at rents lower than the market rate. It's a direct attempt to ease that housing cost burden for young people.
So it's stability delivered through, patient capital, long-term assets, a very different model from the instant but fragile digital peg.
Completely different philosophy.
Okay, so we've seen KB voluntarily investing trillions, but now let's look at the other side, that mandatory costs being put onto the banks.
Right, the regulatory pressures.
There's this legislative move described in the sources. It could really increase the financial burden on the big domestic banks. Seems like the system is pushing them to carry more social costs, whether they volunteer or not.
Yeah, it's focused on government levies, specifically the education tax. The ruling party is drafting an amendment to the Banking Act.
And the changes.
It would basically stop banks from passing on increases in the education tax to customers through their loan interest rates. The add-on rate, the grise.
Ah, okay. So if the government raises the education tax levied on banks.
The bank can't just hike the borrower's interest rate to cover it. They have to, eat the cost themselves, absorb it.
And what's the potential impact? Do we have a number?
The estimate for the top 5 banks, if this passes, could be up to 1 trillion KRW annually, or total.
The source implies an ongoing annual burden, but the exact time frame isn't specified. Still, 1 trillion KRW.
It's not small change, even for them. It directly hits their profitability, raises their cost of doing business. It really poses the question, who ultimately pays for government levies? The institution or the customer? The government is trying to force it onto the institution here.
So that puts pressure on their bottom line, which maybe forces them to compete harder elsewhere.
That seems logical. If costs go up in one area, you try to boost revenue or cut costs somewhere else, which might explain Woori Financial Group's big retail push.
Right. The Woori Financial Together Festa, the UDAPE, that was tied to them becoming a comprehensive financial group, wasn't it? After buying the insurance companies.
Exactly. Tunyang Life and ABL Life. They used that milestone to launch this big customer drive. Very aggressive incentives.
Aggressive how? What were they offering?
Well, for starters, savings products hitting up to 7% interest. That's combining deals from Woori Bank and their savings bank subsidiary. They claimed it was the highest rate out there at the time.
7% is definitely eye-catching.
Definitely. And they also had these interesting little mini insurance products, like coverage for the flu or fracture for a tiny one-off premium, trying to engage customers on multiple fronts.
Small ticket items to build engagement.
Yeah. But maybe the most interesting part, especially thinking about future customers, was from Woori Investment Securities.
What were they doing?
Giving away fractional shares of big U.S. tech stocks. Tesla, NVIDIA, Apple. Up to 20,000 KRW worth just for opening a new account.
Okay. Tapping into that retail interest in global stocks.
Right.
Very tangible.
Very tangible. And apparently it worked. The sources say they got huge interest immediately. Over 200,000 people signed up for the notification about the campaign in just over a week.
Wow. Okay. So despite all the market gloom and these new regulatory burdens potentially looming.
Retail customers are still very responsive, especially to clear, high-value offers that improve their own bottom line. It seems banks are trying to offset those mandatory burdens by really doubling down on voluntary customer rewards.
It's a push and pull. Hashtag, hashtag outro. So we've gone from the absolute chaos of a stablecoin hitting 5,700 KRW because the basic plumbing wasn't there,
Right, the lack of institutional liquidity.
through to KB Financial investing trillions over decades in actual physical stability like railways.
Housing, yeah.
And then landing on these new regulatory costs being forced onto banks, and their aggressive response to win customers with things like 7% savings rates and free Tesla shares.
It paints this picture, doesn't it? A financial world just searching almost desperately for stability. But the methods are completely different. For crypto, it seems stability needs external controls like these market makers.
Institutional guardrails.
Yeah. Whereas for traditional banks, stability is increasingly being enforced through regulation, through things like this education tax burden, making them carry more weight.
So here's something to think about maybe. If stablecoins really want to be the foundation for digital money, how much regulation, how much of that sort of government-imposed burden, like that 1 trillion KRW tax potentially hitting traditional banks, how much of that is needed to build the deep institutional trust for these digital coins to actually be stable in the eyes of everyday users?
The cost of trust. Whether it's a digital code or traditional bricks and mortar, it always seems to come with a hefty price tag, doesn't it? Something to mull over.
Definitely. Thanks for joining us for this deep dive into the sources. Catch you next time.